Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and this video we're going to be talking about 10 ways you can avoid the early withdrawal penalty for your IRAs, also known as your individual retirement accounts. Now, there's a lot of reasons you're going to want to access your money in your IRAs early. A lot of people that we work with simply just want control of their money. You're sick of having the government have control of your money. And the tax ramifications and the risks that come along with it. And sometimes life just happens and you need access to more money. Unfortunately, a lot of people have structured their lives financially in a way where you don't have a lot of liquid savings. And sometimes there are instances in life that you can utilize your retirement account to help meet the needs that you have on a short-term basis. So behind me on the board, I put together a list of the top 10 ways, the 10 ways that you can access your IRA money. You're still going to probably have to pay taxes in most situations, depending on what your tax threshold is. You got to look, everybody's going to have a different perspective from that, like a situation that you kind of have to evaluate your tax ramifications. But with an IRA, typically before 59 and a half years old, everybody's got to pay a 10% penalty to access that money early. I'm going to show you the 10 ways that you can get around that, and the 10 use cases, I should say, where you can utilize your IRA money in certain situations up to certain levels for life right now without having to pay that penalty above and beyond the taxes that you're required to pay. So let's get into it. So the first way that you can avoid paying the early withdrawal penalty for your IRA is higher education expenses, whether it's you, your spouse, children, grandchildren, it'll work all the way across the board. You can actually access your retirement money, your IRA, for paying for college expenses like tuition, room and board, books, stuff of that nature. As long as a student is in school more than half time, you can usually qualify to avoid that early penalty. The second way that you can avoid paying the penalty is for first-time home buyers. You can actually access up to $10,000 from your IRA to go to acquisition costs for your house. And there are some nuances for this that you want to look into, but for the most part, if you're buying your first home and you're going to utilize the $10,000 for like a down payment on the house, you can actually pull that money without paying the penalty on your IRA and utilize it for your first home, help you get to that goal of being a first-time home buyer, which is a phenomenal thing. So the third way that you can avoid the early penalty for your IRA is utilizing it for health insurance costs if you are unemployed. Here's the deal. Being unemployed, if you have filed and received unemployment insurance for 12 consecutive weeks, that will put you in a position where you can qualify to be able to utilize your IRA money to continue paying for your health insurance costs, and you won't have to pay the penalty. Obviously, they don't want you when you're on hard times to be completely up the creek without a paddle and stuck, and health insurance is obviously a huge deal, so they want to make sure that you are able to maintain that insurance. So if you have IRA money sitting there and you're out of savings and you've kind of burned through your emergency fund, or are like most Americans and didn't have enough in an emergency fund to begin with, you can utilize your IRA to help you kind of transition and hopefully get back on your feet, cover your health insurance, and not lose that coverage in the process. All right, so the fourth way to avoid the penalty is through death or inheritance, right? So if you happen to inherit an IRA from a family member who has died and you were the beneficiary of that inheritance, you can actually take a distribution from that before you are 59 and a half without paying the penalty. Once again, you are still subject to the taxes. That's an individual situation that you got to kind of look through and talk to your accountant about what your tax liability is, but you can avoid the penalty by utilizing and distributing that money ahead of time. So it's a big deal. Once again, the whole idea of taxes and the penalty, especially when we're talking about from an inheritance perspective, you want control of that money. And if you believe taxes are going down, do that again. Once again, understanding that this is all about control of your money. So if you inherit the money, you want to control that money as much as possible. And this all goes to you doing what you, with your money, what is in alignment with your values and beliefs. So if you believe taxes are going up and you get to avoid the penalty, you're still going to have to pay the taxes potentially that year, but you're never going to avoid the taxes altogether. You're going to have to pay taxes at some point in time. The The real penalty that you had to deal with was that early withdrawal penalty. If you can avoid that and regain control of your money, utilize it for other assets such as real estate or other kind of businesses or something of that for your nature, whatever you have an affinity towards that you feel like you can have more control of and get a better result, invest for cash flow, regain control of all that. That could be much more beneficial for you, so it's something to consider. All right, so the fifth thing is unreimbursed medical expenses. Here's the deal. This is a little bit more complicated. If you are unreimbursed for medical expenses and the expenses are more than 7.5% of your adjusted gross income, you could potentially utilize a distribution from your IRA to pay those and be penalty free. For example, if you have $100,000 of adjusted gross income and you have a medical bill that's more than $7,500, which is 7.5%, it can qualify you to use an IRA distribution to cover that medical expense and not have to pay the penalty to do so. The sixth way to avoid the early penalty is birth or adoption. I don't know if you know this or not, but for every birth that you have and every adoption that you make, you're able to access $5,000 per child per instance of utilizing your IRA money for each situation, right? And avoid the penalty. You don't have to pay that 10% penalty on that that $5,000, up to $5,000 per. Let me do that again. I got to do that. Was just horrible. So the sixth way that you can avoid the penalty is for birth or adoption. Great part here is for every child, every situation, for every birth, every adoption, you can access up to $5,000 penalty free from your IRA account to help with each occasion. It's really nice to those families that maybe have started an IRA, are looking to add a new little life into their world and utilize that money to help with the transition, to help get things rolling. And it can be really helpful, obviously, because when babies are born, I know I got 3 of them, time crunches, all this stuff, it could be nice to have a little extra cash kind of on the sidelines just in case to help with that transition. So that's number 6. So the 7th way is an unfortunate way to avoid the penalty, and hopefully this never happens to you, but if it does, you are able to avoid the penalty by being totally and permanently disabled. And if you are totally and permanently disabled, you are able to access your IRA money on a permanent basis without having to pay the penalty. So it effectively puts you into retirement before your retirement age, right? Because you're disabled. And so they've created a workaround that allows you to access your money without paying the penalty. But here's the deal. You have to be totally and permanently disabled. I know there's a lot of people out there that are partially disabled and not totally and permanently. It's not going to qualify you. So you got to make sure that you qualify as totally and permanently disabled and you can access your IRA before you're 59 and a half without paying the penalty. The 8th way of avoiding the penalty is if you have to pay an IRS levy. Now, once again, I hope this doesn't happen to you, but should the IRS decide to levy your income or assets in any way, shape, or form, and they decide that they need to levy it against your retirement account, or you decide that that's a way that you want to settle a tax debt with the IRS, they're not going to take money out of that and charge you a penalty to satisfy a debt that they have with you. So once again, hopefully this never happens. You don't find yourself in this situation, but unfortunately, a lot of us do. I've been audited a couple times. It is what it is. It's not fun. You deal with it. Hopefully you have the money to just pay the taxes. If you don't, and you know, you lose an appeal or anything of that nature, you have this money sitting in your retirement account and you could just kind of clean it up, move on, because you don't want an IRS levy on your credit report and in your world. It can totally mess up your ability to go out and invest for other opportunities when the opportunity is coming. And what I can tell you right now is coming into the 2023 here, the opportunities that are going to be available if you are in a situation where you have any of this going on, you want to clean it up as soon as possible so you can take advantage of the sales as the economy kind of goes through this shift and more and more, I guess, assets, opportunities to buy these assets kind of present themselves to you, whether it's real estate or whether it's other kind of businesses or, you know, cars that are going into discounts. There's a whole foreclosure, our foreclosures are increasing right now. Repossessions on cars are going up. So there's going to be all sorts of discounts on these assets that you can leverage for different ways to create cash flowing assets. And if you have bad credit, you're not going to be able to take advantage of any of it. So really consider that as a solution. All right, so the 9th way is for our active reservists. So if you're a reservist in the Army, Navy, Marine Corps, public health, what is the other one here? The Coast Guard, there's Air Force, that's the other one. That's the one I was looking for. So if you are a reservist for any of those, you can, and you've been deployed in your active deployment and you've been that way for, I think, 180 days or more, you're gonna wanna get into this. There's a lot of rules around this, but just know that if you are an active reservist and you're deployed and it's kind of an open-ended deployment and you are in that situation, then you can access your IRA money penalty-free to kind of help the family in that situation. And they obviously, you're serving your country, you're doing all these things, so thank you for your service if that's you. And they want to make sure that your family is not more burdened as you are going and dedicating your life to protecting our country. So that's a big deal. Like I think that's kind of a cool thing that they do for active duty reservists. So the 10th way is one of the coolest ways, and it's something that a lot of people can qualify for, but I do want to throw a caveat out there that it's very complicated, and you don't want to do this on your own. You don't even want to do this working with a life insurance agent. You don't want to do this working with an advisor. You want to do this working with an enrolled agent or a CPA, where they can help you understand how the tax rules and the code kind of fits around your world. But ultimately, it's called the 72T rule. It's basically you need to take substantially equal periodic payments. Now, what that means is you have to figure out a disbursement amount, and it's got to be a large sum, and it's got to be over a period of time. It's got to be consistent. You have to be able to meet those goals and those distributions every year from where you are right now to the time you turn 59 and a half. And if you ever miss it, then you're going to run into a big problem, right? So you need to make sure you work with a CPA that understands this or an enrolled agent that understands this. I'm not going to go any deeper into this because I don't even want to tread on the danger of trying to give tax advice in this world. Just know that it's an option. If you haven't looked it up, and I'll try to get a guest on actually to do 72T conversation around that, because it's a really, really powerful tool for you to be able to leverage and access your IRA money without having to pay the penalty. And you can utilize that money for other things, which I know a lot of people are looking to do right now, especially as we enter this market where a lot of people believe that taxes are going up. So why not pay the taxes now if you can avoid the penalty, recontrol that money, and elevate get that money working for you in areas that you have control of and that can help you produce more cash flow and reach financial freedom faster. That's what it's all about. So anyway, those are the 10 ways that you can access your IRA without having to pay the early withdrawal penalty. Hopefully it helps. If you have any questions, comment in the comment section below. If any one of those is an area you want me to dive deeper on, let me know. I'll bring a guest on. I'll do what I can do to create more content around it. And that's it. Until next video, have a blessed, inspirational day. We'll talk soon. See ya.